Global stocks stay volatile, but are the nerves justified? Welcome to Market Insight. I'm Elena Casas. European indices are still wobbly today after hitting a 6-month low on Monday on fears the US could be heading for recession. Markets have increased their bets on rate cuts after a handful of weak data points. But was there a fundamental reason behind Monday's sell-off? Let's ask Russ Mould, Investment Director at AJ Bell. Russ, does the data justify those US recession worries then?
Well, I think we have seen some shaky numbers. I think what obviously upset everybody were the non-farm payrolls figures on Friday, which were much weaker than expected. But we had a shaky purchasing managers index for manufacturing during that week when order intake was very weak, but pricing was actually still quite sticky, which is a bit of a nightmare stagflationary scenario. The new housing sales market really doesn't look very good at all. And we have seen an increase in unemployment from the lows of around 0.75 percentage point. I know there's been an awful lot of bandying about that figure recently, saying that the SARM rule suggests that that may mean that a recession has already begun. So there are some figures out there that would give some cause for concern. Yes.
That wasn't the only factor, though, in Monday's big sell-off, was it? One of the other key things is the rise of the yen. Why has that had such an outsized global impact?
Yeah, we could talk about the yen carry trade from now until Christmas, probably, and still not thoroughly explain it to everybody. But what seems to have been going on is that a lot of institutional players, possibly hedge funds, have been using very cheap yen because the interest rates there have been zero or negative for a long time, and then using that cheap money to buy assets overseas in other currencies to leverage their returns. Now that works well when the yen is going down and the other assets are going up. But as we've seen, we've had this certainly this remarkable coincidence that after the Bank of Japan has begun to tighten policy, the yen has rallied against the dollar and on other currencies. And that has then certainly coincided with this wobble in Western securities prices. So it is possible that losses suffered on the yen have forced some investors to then close out those shorts and liquidate their overseas positions. So there may be a link, there may not be, but it's certainly an intriguing coincidence, if nothing else. Now, that makes the call for Fed interest rate cuts very interesting because that would further close the interest rate differential between Japan and America and conceivably make the situation worse, not better.
If the Bank of Japan does keep hiking rates then, as it has said we should expect, how are you expecting those investors, those hedge funds who've relied on that cheap liquidity to adapt?
I mean, I'm sure they will adapt. I mean, they may be forced to buy their margin clerks if things keep on going wrong. But at some stage, you would expect that process to wash out. But the short positions against the yen, looking at the Chicago Mercantile Exchange figures and the US CFTC numbers, were very, very large by historic standards. So it could be a source of volatility for some time to come if the Bank of Japan stick to their script and if the US Federal Reserve stick to theirs.
Are US stocks just overvalued, though, Russ? Is that another key factor there? Have they just got too high?
I think there have been people arguing that for 18 months or 2 years or longer. And I think, valuation is never a timing tool. I think there's an old market saying that, valuation never tells you when, but it does tell you how far. And at some stage, they will start to have an impact either because things are too cheap or things are too expensive. I think the one thing that probably isn't priced into US equities, to go back to your first question, is a real slowdown in the US and a deceleration or even a drop in corporate earnings. So if you look at what markets have priced in over the last 18 months, they've priced in a cooling in inflation, a soft landing, and interest rate cuts. Well, inflation's been a bit sticky. Maybe we're now getting a harder landing, and those rate cuts haven't come yet. So that perfect scenario that's been priced in isn't transpiring as smoothly as hoped. I think that, again, is probably another contributor. If you look at the US on price earnings, market cap to GDP, Schiller Cape, yes, it does look expensive relative to its history, but it has done for a while. What you're then looking for is what's the catalyst that will make people think that way? And the most likely candidate right now, setting aside the technicals with the yen, would be a sudden unexpected slowdown in the US economy. That would be a nasty surprise if it were to transpire. And I'm sure the authorities will do their best to make sure it doesn't, certainly ahead of an election in November.
If we do see some weakness on Wall Street, though, is there an upside here for markets that have been cheaper in recent years, the UK in particular?
I mean, it may be of scant consolation, but we certainly haven't, to shareholders there, but we certainly haven't seen the UK or Europe go down as much. Admittedly, you can't necessarily take relative performance to pay your bills, but it's certainly a starting point. And the UK and Europe are not as heavily exposed to the sectors that have proved particularly volatile in the US and Japan, for example, such as technology and anything related to AI. So that may well be a saving grace. And again, it does come back to valuation because the valuations there are not extended relative to their history. So that again may mean that they offer some, some a little bit of protection perhaps during these tricky times.
What about Europe's most highly valued stock, Russ, Novo Nordisk, which reports tomorrow? It's had the weight loss market to itself for a while, but is now facing increasing competition. Do you think it can justify that valuation?
And again, if you look at any company over any long period of time, competition, customer disaffection, or regulation will get you in the end. I think at the moment, Novo certainly isn't suffering any customer disaffection. Quite the opposite. If anything, its challenge remains: can it make the stuff quick enough? And I think when you've got the UK National Health Service saying that it's more or less sold out until Christmas at the very least, I guess the challenge then for Novo is if it's bumping up against capacity straight constraints, how can it keep on surprising on the upside to keep investors happy? Because if the news is so good it can't get better, then if it can't get better one day, it might get worse, and that might be enough for investors to again think, okay, valuation's pretty full here, but I'm sure there'll be a very strong set of numbers that they report tomorrow.
Russ Mould of AJ Bell, many thanks for joining us. Well, that's your market insight. Don't forget, you can watch more videos on Reuters.com.